and I think what a lot of people do, they're kind of fighting against this tide. They're kind of saying it's not going to work, that there's going to be, a price to pay for this, and it's going to all kind of collapse on itself. And I think, like I said, maybe there is a bubble gets blown up and it eventually does. But I think that in the short to medium term, there's going to be incremental success on all of these fronts. And when you combine all of that, then you're going to get this drive into risk assets. And I don't want to sound like a broken record, but I think that there's a lot of good people that get into a lot of the nitty gritty on data, and they'll look at things like PMIs, which are doing better. They'll look at things like industrial production, which is doing better. Germany, I think, recently had a really good, industrial production number, supposed to be like 0.4% growth. It was like 2.5%. So there's a lot of things out there that are happening, kind of under the covers, that a lot of people, they're just kind of focused at, well, we just had $900,000 in job revisions. True. And we had a little tick up in jobless claims. But again, that's the reason to be bullish, because that's the impotence for governments to say, hey, we've got to get housing going. Hey, we need to pressure the Federal Reserve to lower interest rates. Hey, we've got to keep up with our fiscal spending. We can't go into austerity because we are in a fragile quasi-recessionary economy in a lot of areas. And so these are all reasons, and this is the disconnect between the real economy and markets. And so, you can have a situation where the Mag 7 basically has very little in new net hiring, and yet their profit margins increase 20%. And that's what, drives the earnings momentum that pushes these indices higher. And yet at the same time, there's this Wall Street, Main Street dynamic, which is very troubling. And that could be another reason why this whole thing blows up, is civil unrest. Obviously, we had the Charlie Kirk assassination last week here in the United States. We have had riots on the streets in recent years for various reasons. We have the socialist candidate, Mondami, perhaps on the verge of becoming the mayor of the financial capital of the world and America's largest city. So look, we've definitely got our issues. We're a bit of a basket case here. And I think that's what scares people. But it's like, you've got to look at those underlying kind of flow dynamics with debt and deficits and earnings and different things. And the fact that there's this civil unrest is just going to push politicians around the world to be even more aggressive with driving a booming economy to quell the masses. I mean, you had like riots in the streets in South Korea the other day, and they were protesting Chinese immigration. You have a lot of these movements on the left and the right in Europe. So you have a lot of political foment in the air. And so you have all of these things. And I think if you let all of these things kind of stop you from kind of taking that leap of risk, then you miss out. And I think what's going to possibly happen is eventually everybody's going to kind of come around to something akin to the view I've been outlining, and think there's nowhere to go but up. And at that point, everybody will be in, and that's when the Minsky moment comes, and that's when you get another 50% drawdown, which, like I said, we've had a couple of those in the last 20 years or so. So this is the game. I mean, equities are a risky game. They've always have been, and there's just all these forces at play. But I think that trying to time like an imminent collapse at this point is premature.
And how do you know when to get out? I guess that's the $1 million question.
I think a good thing will probably be like just absolute sentiment. When at the end of 2024 was when I turned bearish for the first time in a while, basically since the 22 lows. And I started buying puts and raising cash in December and January. And one of the reasons was because every single Wall Street equity strategist was coming out with price targets around 7,000 on the S&P. And I just, I felt like the consensus, the American exceptionalism, Trump's going to come in and do all these bullish things. And I'm thinking like he's going to probably threaten Federal Reserve independence. He's going to lay on tariffs. There could be political unrest because he's a divisive personality. I'm like, there's some hurdles out there. And so I think that basically, a good barometer for when to get out is when the voices are very few and far between, from kind of mainstream voices, strategists on the street, when there's just this ebullience and sense that there's nothing that can happen except for a huge rally. And like I said, we're not there yet, and I don't know when that occurs, but I wish I could have a more satisfying answer, but the thing is I think ultimately markets are much more psychological than people realize, because there's no ordained valuation. There, anybody can come up with any argument about why PEs should be this or that, and they can look at the CAPE and say this is the historical. Or you could get a Tom Lee out there who says, look, the equities have taken like 5-6 huge shocks in recent years, and they bounced back from all of them. They deserve a much higher PE. You could say, interest rates are on their way down. We need to expand. Like, you can always make these valuation arguments, but ultimately, I think there's a fundamental kind of psychological factor to the markets. And I just think that at this point, we're just not anywhere near the type of blanket bullishness that would start to get me concerned.